An IPO is an initial public offering. This is where companies who want to become publicly traded will go out there and sell shares of their business. So why am I bringing this up? I'm not bringing this up to teach you about IPOs. I'm bringing this up to show you the history of IPOs and what it says about the market. So here's what happens in an IPO. I have a company, ABC Corp, and I say to my investment bankers, guys, I want to go public. So they say, okay, give us your financial data. They give it all. And then you know what they do? They go on a roadshow. It's actually called a roadshow, and they go sell the F out of your business because that's what they are. They are salespeople. More power to them, but they are salespeople. Their job is to build up so much excitement in your company that everybody has to have your shares. And think about it. They're going to be paid very well the higher the price they get in the IPO. So, question for you. If their job is to sell, are IPOs going to be better or worse during good times in the market? Are they going to be better or worse during bad times in the market? They want to IPO when the market is so hot and heavy and awesome that people are like, I gotta have any stock I can get. So let's go back to 2000. And I saw this data the other day and I was absolutely blown away. Going back to 2000, there's been almost 6,000 IPOs. Okay. And this is it by year. So if you look at the screen right here, back in 2000, at the peak, 397 IPOs. And guys, look at this. Bad market, amazing market. Do you see what I'm saying here? This is all, when it comes to good and bad markets, there are going to be more and less IPOs. This to me tells me how crazy this market was. 1,035 IPOs last year. Guys, we've had 5,900 since 2000. One in every six, more than one in every six was just last year alone. And if somebody tries to tell me with a straight face that this stock market was a rational stock market, this right here alone tells me how crazy it was. That anyone and everyone could absolutely go do this. I was reading a book yesterday by Peter Thiel, 0 to 1. And in it, he talked about a friend of his from Stanford that literally, back in the dot-com bubble days of the late 90s, literally planned his IPO before he started the business. And this market last year for IPOs was hotter than back then. Hotter than back then. Think about that. Now, let's go look at it month to month. Look at the IPOs by month. January and February, markets was still up. June, July, August, this time, well, markets started to rebound in July, but it's going to be a lagging indicator to there. Because remember, they can cancel the IPO up until the date of the IPO. Their job is the investment banker's job is to go on a roadshow and say, look at this great company. It's so awesome. You got to have shares. Buy. And if you've watched our past videos, you know I don't buy IPOs. Why is that? Well, if you're new to the channel, I'm Paul. I'm a value investor. I like to look at long-term trends and long-term numbers within a business to make a decision. I want to be able to buy a business at a discount to intrinsic value where the price is mispriced from the value, but also where I can reliably estimate what they're going to make in the future. With an IPO, they're only going to give you a couple or a few years of data. I don't know. And they usually are smaller companies. Smaller companies have a harder time staying around. I prefer to stay out of it. That doesn't mean that you should avoid every single IPO. But if you look at the history of performance of IPOs, they tend to not do very well. Spoiler alert. Not every IPO is Apple, Microsoft, Oracle, and all these major companies that have become huge. Most IPOs are companies trying to look for some sort of exit. It's usually when the owners are trying to get their big payday. I don't think they're very much in favor of the investor. They're in favor of themselves. And that's the hard part. So when I look at these monthly numbers, this is just indicative to me of where the market was. And is. This is it. Now, so don't look at September because it's only September 13th right now. So we're very early on. But we're over a third of the way through the month. We've only had 3 IPOs. So we're already tracking for a very, very bad month of IPOs. And I actually like seeing this data. To me, when I saw this data of 2021 at 1,035, I got tingles all over, guys. I was tingling up and down. And the reason being is I sat there and said, some validation of how crazy that market was. They were literally willing to IPO anything. And I guarantee you, those investment bankers told every single person out there, listen, you got to IPO now. The market's hot. The market's hot. And guess what? Those investment bankers are salespeople. They're not investors. They get paid by selling the crap out of these IPOs. More power to them. They can provide a lot of value for people, but they're not Investors, there's a big difference. Just because they work in the business of money doesn't make them investors. Just because your car salesman works in the business of cars doesn't make them a mechanic. They can't build a car. They can't repair a car. Same thing here. And I want to encourage you to think a little differently. You are going to make a lot more money in life by programming yourself to think differently. So how do you do that? Well, guys, I was in probably a lot of your positions out there 20 years ago. I believed in buying companies that have great futures and the future's bright, and I didn't care about value. And then I experienced a couple crashes and I thought to myself, what the heck? This doesn't make sense to me. How could a guy like Warren Buffett and another guy like Charlie Munger and Ben Graham and all these greats of investing do so well when everybody else is sucking? And then I started to pay more attention. And I started to realize value was driven by the fundamentals of the business. And eventually, over time, the price and the fundamentals would converge in most cases. And that was my epiphany. But it still took me many, many years to really embrace that inside. It took a long time. Why? Well, because you can't just change overnight. It does take a while. But when it did take on, and I'm still learning every single day about this, my life became easier. I was able to sleep better at night, knowing I was buying a business and not just a ticker symbol. When I bought a business, I did not care where the stock price went. Is that really true? No, I still am like you. When the stock goes down, I go, am I right here? Is this right? Maybe I'm not, but it allows me to go reevaluate the investment at all times. And that's what I love. I love doing that. As long as my thesis is in place and I realize that the stock is changing price because of the market's reaction, I'm at peace. And that's what makes me happy. But I love seeing things like this. I love seeing the 3 metrics. If you watch our past videos, there are 3 metrics I look at for where the stock market is at a given time. The stock market to GDP ratio, this 10-year cyclically adjusted PE ratio, and the price to sales ratio. And every single one of them says that we are double where we should be historically. The current stock market GDP ratio is 160%, give or take. It should be around 80. The current 10-year cyclically adjusted PE ratio is a little over 29. It should be between 15 and 16. And the price to sales ratio is currently around 2.4. And historically, it's been around 1. But even with more service businesses, call it 1.2, 1.3, still double where it should be. And these are 3 of the most reliable metrics to long-term pricing in the stock market. And that is what I make my decisions based on. Does that mean I try to time the market? No. I still own stocks today that I bought because I think they've fallen in price. If I really was trying to time the market, I would buy in and out based on where I think the market's going to go in the next month or two. What I'm trying to do is say, hey, you know what? I'm not going to overpay for these stocks that I know are overpaying. I'd rather wait for the fundamentals to get better. And that's what I do with IPOs. I don't buy them because I want to make sure they get out there and weed their things out. Get through the junk, get through the BS that they have to get through as a company, and let me see a more stable fundamental business. Now, do I regret this? Well, let me tell you a story. Back in 2004, my bank offered me shares of Google in the IPO, and I said, I don't do IPOs. Do you think I regret that? Absolutely. But there are so many other IPOs they offered me that now I can't even tell you any of them because they probably all sucked. So even if I invested in Google, if I invested in all the other ones, I probably would not have done as well. So that's something to keep in mind, that yes, I'm going to miss out on some Googles of the world, but I'm also going to miss out on the dozens and dozens and dozens of ones that they gave me that I said no to because I don't do IPOs. And guess what? I will still own Google at some point at a much better value than it was back then. I cannot blame myself for those decisions. So if what I'm saying makes sense to you, you absolutely need to watch the next video on margin of safety and how I look at margin of safety to make better investments. Thank you very much, and please subscribe to the channel.